started. Thank you everyone for joining us today for our fourth and final webinar in our Focus Forward 4-part webinar series with Ms. Carey Wallace. She is the founder and consultant of Agency Focus. It's a consulting company whose mission is to help grow your agency, and she's very passionate about helping independent agents understand their value and make informed decisions for their agency with a focus on the independent agent. So today, Carey will be talking about KPIs, which are metrics every agency owner should know. So in this session, she's going to break down the most important KPIs in the industry, from revenue and premium volume to retention, performance, and financial metrics. So if you have any questions during the webinar, you can just type them into the chat and we'll share those with Carey an appropriate time to answer. So Carey, take it away.
Thanks, Carson, and thank you for having me here. I always love joining the agents in this great state of Louisiana, so thank you for having me. So before we get too far in, I started in this industry several years ago, and you guys have all kinds of acronyms for everything. I only get two. One is KPI and one is EBITDA. And I'm going to explain what both of them are to you, but KPI is a key performance indicator. And so the cool thing is you're in an industry that has more data than it knows what to do with. If you are a best practices agency and you've gotten a best practices report, you know that there's more metrics on there than most people can really consume, and if you are able to consume them and you know what they mean, knowing what action to take is also a challenge. So a key performance indicator should be something that helps you take action. It is measurable, it's timely, and it's tied to your overall strategy. So if you're looking at a metric and it doesn't drive action, or you don't know what to do with it, it's probably not a KPI that you need to pay attention to. And I would also recommend don't pay attention to more than 5 metrics, because at that point it just becomes numbers on a page rather than something that you can do with it. So I'm going to go through the KPIs that many of our clients or we encourage our clients to take a look at, why it's important, what they do with it, how you get to those metrics, and make sure that we're all talking apples to apples when we're talking about these different metrics. So again, lots and lots of metrics inside this industry, and it's important to decide which ones make sense for you, where you are in your trajectory of your agency. What's right for some may not be right for others, but I'm focusing on the ones that I think every single agency owner should know and understand. Why in the world do we need to have them in the first place? I think it creates a purpose and a strategy around what you're doing and can improve your performance, because now it's based on data, not just your gut. The reality is, I'm an entrepreneur. Most people who are agency owners are very entrepreneurial. Their gut has got them where they're going to go. But if you add data and true, concrete information around what they're trying to do, combined with their gut, it becomes an incredibly powerful thing. So I think having that knowledge and how it can create some power and allow you to be really, really thoughtful about what you're doing to grow your business. It can improve your overall performance. No question about it. It can enhance the value of your agency if you know what metrics to look at and what metrics a potential buyer would look at or a potential successor would look at. That is really important. It can help you focus your energy where you should be focused, rather than all over the place and maybe chasing your tail with something that maybe not be as impactful to your agency. And then it can help you plan for the future. So if in all those things, if you're looking at a number and you're like, this doesn't help me understand the value of my agency anymore, and it certainly doesn't create focus for me, I would start shedding those things and maybe not paying attention to them, or not placing as much importance into those, or figuring out, okay, let me understand this and talk to somebody else and find out, what do they do when they look at this number, and what is my action, in order to make sure I'm focusing my time and energy in the right place. what the last several years has taught us is we have a very, very finite amount of time, and we want to make sure that we're using our time as wisely as possible. So the key metrics that I like to focus on are the ones that I encourage my CFO clients to focus on. So agency focus does valuation work. We do perpetuation planning. I think we did a whole series on that as well. But we also have fractional CFO clients where agents work with us and we help them look at their financials, create a strategic plan, understand their budget, understand their performance. And in all of those clients, these metrics are put on a dashboard for them to pay attention to. We look at your growth, we look at your profit, we look at your operating profit, or what would be left over after all the non-cash things are added back. We look at your revenue per employee, and we look at your retention. And honestly, retention should have been right under growth, because we want to know what your new business is, what your retention is, and that really together equals your growth for your agency. The reason these are the 5 that we pay attention to is an agency that is growing and able to do it profitably is an agency that will be more valuable than the same agency at the same size that isn't growing or not able to do it profitably. So these are the numbers that if you really want to know what's driving the value of your agency, you should have a really good handle on. Carson, when she started, said that we were going to talk about different numbers inside the agency. And when I first meet an agency, one of the things I ask them is, tell me about your agency. And the first number that many agency owners give me isn't any of these numbers. It's premium. Well, premium in your state will look and feel a lot different than premium in California, which will look and feel a lot different than premium in North Carolina or South Carolina, where I live, because the commission rates and the market looks very, very different. So I don't really know a lot. If someone leads with premium, I have to know what their revenue is. And then I want to know, are they growing and are they profitable? So while premium is important when you're talking to your carriers, and premium is important when you're talking to your producers, as a business owner, revenue is far more impactful and tells a story a whole lot better about your agency and the health of your agency than premium does. So this is what the fractional CFO dashboard looks like. We've actually expanded it a bit since I've done this slide, and I didn't realize until we were just getting on today to have this webinar. But we look at our revenue and we look at the year-to-date commission and fee income only. That is not total revenue. That's just commission and fee income. We look at where you are. This is actually month 1 for this agency, but where they are year-to-date. Where they are compared to the budget that we put together. And there's a third line item actually in each of these boxes where they were this year for the prior year. So we compare to where they are today, what their budget was, and where they were last year. We then actually calculate their growth rate. I'm going to tell you how to do that. We look at the revenue retention. In the other, a true fractional CFO would also have their total revenue growth rate as well, which would include contingency and other income. But that number can skew pretty significantly in agencies that are large enough and can command profit sharing or contingency. It can also fluctuate down, and if you're only looking at total revenue, it could be misleading what your true growth rate is if you're combining your commission and fee income with your contingency income as a whole. So breaking that out is really important. Then we're going to look at your profitability. What is your operating profit? What is your EBITDA, or earnings before interest, taxes, depreciation, and amortization, which is really, one is just your profit. Revenue in, expenses out gets you your profit, and that's what shows up on your profit and loss statement or your P&L. The EBITDA, you actually have to do some calculations and add things back, but that is the number when you value an agency that is multiplied times the multiples everyone wants to talk about in order to get to the value of your agency. So knowing that and how to get to that and how to manage that is really important. And then I would calculate your your revenue per employee as well as your spread per employee. So revenue per employee is literally your total full-time equivalent employees, including VAs, divided by your total revenue. And the spread is the difference between the compensation for those employees and the revenue per employee is your spread. And that revenue per employee is a great indicator of capacity. The spread is a great indicator of what your predicted profitability would be, your retention. There's a lot of metrics that actually drive to what can I predict about an agency. So this is what a standard dashboard would look like for a fractional CFO client. And I'm going to go closer into some of those things. So I told you growth and profitability and evaluation of an agency or the health of an agency are the two biggest factors. If you are an agency that's growing but not profitable, you will not be as valuable as an agency that has slower growth but higher profitability. The same is true if you're growing super fast, if you're not growing at all, but you're all profit. Well, the question would be, why are you not deploying that and investing in your agency in order to grow? You're going to stay stagnant with that profitability because your top line is never getting bigger for that percentage of profit to grow with the agency. So those two numbers have to stay in balance. And in order to calculate your organic growth, you're always going to take your commission and fee income in this period less the previous period divided by the previous period. What's really important, though, is not all revenue is created equal. So if you're an agent that has revenue that doesn't renew, let's say you have a lot of life that you write, or you have bonds that you write, or you did an acquisition in this year, it's going to skew what your organic growth rate is. So you have to make sure you're taking just your commission and fee income that will renew, and you're taking it in the current period. If let's say you have a big bond book, I would remove it out of the current period. I would remove it out of the previous period. And therefore I would make it that I'm comparing apples to apples. But if I left that in and I counted it as if my agency, it would show that I wasn't growing if I left the bond income in the previous period, but I didn't have it today. So anything that's not going to renew, you don't want it to skew your number. The second thing is if I acquired an agency in this or acquired a book, and let's say I did it in June of this year and I didn't remove it, I would have my current period revenue would have a spike of about 50% of that book already. And when I compare it to my previous year, I'm going to be far greater because I had artificially increased that by buying a book, not writing new business. So your organic growth rate is meant to really just say, how are you growing with green new business, not how are you growing with an acquisition and green new business. So when we value an agency, we'll actually remove any purchased books so we can actually get to a true apples to apples. If you're talking to another agency owner and they're saying we grew by 33% last year, they might have acquired a book, I'm just going to say, but then others, absolutely not. They might actually be growing organically. So you want to make sure you understand exactly what they're talking about and what you're talking about. You also want to understand when you go to look at benchmarks in the industry, you're comparing apples to apples. So that's why I'm going through what these benchmarks mean. So this is a profit and loss statement that's a dummy. This is the Wallace Agency. And I'm showing you which revenue will be used to calculate the organic growth rate. So we would actually use the direct bill commission, the agency bill commission, the fee income, the benefits. We would leave bonds off, we would leave life off, and then we would then say, okay, in 2023 it was $1,051,000. In 2022 it was $925,000. For 2023 we had a 13.6 growth rate. In 24 we had 11.8 for a 12.7 on average. If you didn't do this and you actually used all the revenue instead, and you used the bottom total net revenue, and you looked at the 1.2 million, 1.245 million in 23, and compared it to the 1,040,000 you had in 2022, you would actually overstate your growth rate by about 4 points. So again, it's just important that you're speaking apples to apples, because here's what happens. An agency comes and says, listen, I'm above the industry benchmark in growth. I want to command the highest multiple. I'm also doing it very profitably. So therefore, I should command, if my agency is 5 million in revenue overall, and I'm growing at double-digit growth, better than any other best practices agency, I should get the highest multiple. That's one of the many factors that go into that. But if they're thinking that they're growing and they're actually not growing at the benchmark, they're average, but they're not beating the benchmark, they're going to have the wrong impression about what to expect out of their agency. And it's really hard to manage those expectations if you don't know what those should be. So getting your organic growth rate right and understanding what goes into it is incredibly important. So these are the current growth rates that are published by Reagan Best Practices. Again, we have our own growth rates, but this is what they look like for agencies of different sizes. Let's talk now about growth is important, but what's driving it? Is it new business or is it retention? And retention is one of the best metrics to know inside your agency. You should know what your revenue retention is, what your policy retention is, what your premium retention is. It used to be you could look at just revenue and it would follow policies in a soft market. In a hard market where we all had rate increases, revenues over 100%, but policies could be declining. It could be a much lower rate. So you need to know both, and you need to know how to calculate retention. It's not a number that is easy for you to get in an agency management system. And it also requires that you have the right processes in place in order to capture that number appropriately. So a any retention rate is, again, you take where you are in the current period. Let's say that we were going to do our retention rate through November of this year. I would take what is my revenue January through November in my current period. I would subtract any new business that I wrote from January to November in this year, and I would divide it by the revenue that I had in place from the previous period, January through November. I would do that for revenue. I do the same calculation for policies. I would take out any new policies that were put on the books during that same period in order to get that retention rate. And agencies that know this know when to change their retention. They can identify, do I have a retention challenge? How do I compare to the benchmark? Do I need to do a different process inside my agency or adopt a different process in order to retain the right amount of business inside my agency? But if you don't have this, you could actually be fooled that the agency's growing, so therefore my retention might be okay. And I fear many agencies, especially in this market, as things are softening, if they weren't paying attention to their retention, or they thought that their retention was healthy and actually their policy retention wasn't healthy, when rates come down, the impact to the agency will be far greater because there's less policies. The policies that you have, the rates are coming down. It's not going to look the same for an agency that understood their retention, was calculating it, and able to do and make adjustments as they saw what was happening inside their agency. So there's some profit EBITDA benchmarks for agencies. On the top, it's actually smaller agencies that are 500 to a million. Are 500 and less, 500 to a million to 2 million, 2 million to 3 million, and 3 million and over. And then there's also some profit and EBITDA numbers for agencies that are over a million. One is best practices, one is our data, and our data goes a little bit more broken out in the million, 1.25 and below, because there's 83% of independent agents that fall in that category. So we felt that breaking that out a little bit would be helpful. We also took out any agencies that are brand new that are growing exponentially until they level off around year 5 to 7, and so they don't skew the growth rates. But this basically looks at the bottom quartile, the average, the top quartile, how are agencies faring in when it comes to profit and operating profit or EBITDA. So calculating your EBITDA is something that I think everybody should do. I actually have a hat that says this acronym on it, and I wish that someone could walk up to me and tell me what their percentage of EBITDA is, or even their dollar amount of EBITDA is. I would love if someone would lead with that number. It would make me super happy, because this is the number as a business owner that you control, and it's the number that in the equation of what the value of your agency is, it is the number that all the decisions you make are what drives one part of that equation. The multiple in the marketplace drives the other to get to the value of your agency. So if you're able to manage this number well and maximize it, your agency is going to be far more valuable than someone who doesn't even know what that number is or what it could be. So in order to calculate your EBITDA, I'm going to show you on the profit and loss statement where you find some of this information, but you go to the bottom of your profit and loss statement and find where it says your profit, and you start with that in the top box. And then you're going to add back any interest expense, taxes, depreciation, and amortization. Then it gets a little tricky, and you're going to go through your P&L and say, where are some one-time expenses that aren't going to recur? And you're also going to subtract any one-time income that is never going to happen again. Identify some discretionary expenses inside your agency that aren't necessary, but you're running it through your agency for a tax strategy. And then we're going to talk about owner compensation. So this is what it looks like. This is really busy, but I'm going to show you what I mean. So you're going to start with your pre-tax profit down here. You're going to add back any of these interest, depreciation, amortization, officer life is also something you would add back, and any taxes you've paid. These are taxes based on the profitability of the agencies, not your license taxes that are above. That's the simple, easy things that you can pull off a P&L very easily, as long as it's organized this way, at which many agencies aren't, but you can find these categories on your P&L. Then you're going to go to the owner manager payroll, and we're going to make sure that it represents an appropriate amount. Some owners pay themselves only in distribution. Some people pay them 100% on W-2. On average, for $1 million agency, it should be around 6.9% of your revenue is going towards your owner payroll. So the IRS can give you what that guideline is for any size business. Your CPA should be giving that to you, but it should be a reasonable amount for owner payroll. If it's a 0, you're artificially increasing the profit of your agency. And if you have all of it, including your distributions, you are understating the profitability of your agency. Then you go to your operating and selling expenses and say, did I do anything that was one time? Did I work on something like replacing all the computers, or did I rebrand the agency and that's why my advertising is so high? Pull out those one-time things that you're never going to do again, or you're not going to do on a regular basis. And also any discretionary expenses you might have in dues and subscriptions or something like that. You might have a membership to a golf club or something that isn't really part of selling insurance. And if you were to sell your agency, you would not have that expense continue inside your agency. This isn't judgment about discretionary expenses. It's just a matter of, we want to get to what are the true operating costs of running an agency and selling insurance. And once you do that, you'll get to this ending EBITDA number. And that is the number, the dollar amount is the number that gets multiplied times the industry multiples that you see in the headlines based on the risk inside your agency. But the percentage is the one that we definitely talk about, where the average agency wants to be operating somewhere between a 25 and a 30% profitability would be considered very strong. If you're a really large agency, ignore the number that I just said, but I'm trying to talk in generalities to give you an idea of what that is. But again, If you don't know what the benchmark is and you don't know where you're operating, it makes it really difficult to know, am I healthy? Am I not healthy? Am I able to get to a healthy level? And do I need to do anything differently? Are there decisions that I need to make inside my P&L and where I'm allocating my resources? It'll be a really great indication to say, do I need to make some changes? So we have growth metrics that are industry benchmarks. We've got profitability metrics that are industry benchmarks, and we've got that EBITDA benchmark to help us. The next one is revenue per employee. This is a tricky metric because our industry is changing fast. There are agents that are leveraging virtual assistants. There are agents that are leveraging technology. There are agents that are leveraging AI in order to change the way their people do their work. And all of those things are impacting what is the expected revenue per employee, what's the expected amount that a CSR should be able to handle or an account manager should be able to handle, what's the expected new business that a producer should be able to write. Like all these expected numbers are starting to change. Because if you start to break up the role of what a licensed person is doing and maybe move some of that to an unlicensed person, it allows to have more capacity in order to maximize what that licensed person can do, whether it's service or sales. And it's changing this number. So really efficient agents are blowing this out of the water. If you're an agency that's super tech forward and your revenue, your growth rate is not higher than other agencies, and you're not at a higher revenue per employee, so you still require the same number of people to do the work, you should ask yourself, is the investments in tech and AI actually paying off? So it really is a guide to say, if I'm not really, investing heavily in technology, I probably need to have more people in order to do the work than someone who is investing in tech. So some of these metrics start working in tandem with each other to figure out what are the expectations for an agency in my situation with my investment strategy. This is an average. This revenue per employee changes based on where you are, what the average commission is, if you're personal lines heavy, if you're commercial lines heavy, but I just gave you a range of what the average is for $1 million agency. And again, the factors impacting a revenue per employee is your use of technologies, whether or not you're utilizing virtual assistants. Are you tiering your customers, or are you treating all your customers exactly the same? Will also impact your ability to get through the work. Whether or not the agency utilizes automation and whether or not the agency has policies and standard practices will all impact what their expectations will be on their revenue per employee. An agency that's got really solid and very consistent policies and practices can employ virtual assistants in order to create more capacity at a lower cost in order to allow their higher cost licensed people to be able to do more work. And again, they'll actually potentially be more profitable than an agency that doesn't have that ability, because they don't have standardization and they're not able to then identify those repeatable processes that someone else can do and not disrupt the whole flow of the agency. So truly is something that's changing pretty rapidly. It used to be that it was nice if you had technology and automation. Now it seems to be the norm. And I will also say those agencies that are not innovating will, the gap between the agencies that are innovating and the ones that are not innovating gets wider and wider as we continue to move into this, state of the technology and AI being so commonplace for everyone. All agencies should look at their revenue or look at their P&L on a monthly basis. I'm still shocked sometimes when people come to us to get valuations and they really don't look at their monthly financials. But the reality is sometimes it doesn't mean much to them. So I would also tell you, when you run your financials in your QuickBooks or in your agency management system, it gives you an annual amount that you're paying, but it also should give you the percentage of revenue for each of these categories. So in order for it to be really meaningful to you, you have to know, A, what are the categories in the industry so you can compare where you are to where the industry averages are to know, am I spending the right amount on my people? Am I spending more than the average agency, or am I spending less than the average agency? How about technology? Am I spending more or less than the average agency? Once you have your P&L categorized the same way as the benchmarks, you can start answering those questions by doing, what is the percentage of revenue that I spend on my people? For this case, total compensation is $858,250, or 61.2% of their revenue is going towards their people and benefits. The average agency is 56.4. So this agency, this example, is spending 4.8% more than the average agency on their people, which will be difficult to make up. Therefore, they won't be as profitable as other agencies that are able to spend less. You can see for them, their selling expenses are actually slightly under, but their operating expenses are under, making them roughly the same profitability. But that is really the way you could start thinking about, how am I running my agency and how does it compare to others? If this agency is growing double digits and it's maintaining a 20% profitability, we would care less about how much they're spending on their people, because they're probably staffed for growth. But if they were a flat or declining agency, we would start to ask, why is that? And are we able to get more profitability and more productivity out of those agencies? So again, you have to have context, but by putting it as a percentage of revenue, it allows you to compare it to benchmarks and then make some sense of what this statement's saying to you, not just where are you and what's my bottom line, but how do I compare to other agencies your size? So once you have that, you can compare to benchmarks, you can consider your ROI on some of the investments that you're making, like marketing and technology, whether or not you want to keep multiple locations. Do you want to hire coming forward? You might be able to eliminate some unnecessary expenses. If you see, oftentimes people, hear about tech, they implement it, it's not being utilized, it stays there, it's not a huge expense. But then you look at a percentage of revenue that you're spending in tech and you realize, I'm double the average agency. Maybe I should dig in, see what I'm spending. And you can eliminate some of those things that maybe didn't work out the way you wanted them to. It's done in marketing oftentimes as well. You can really quantify how much are you spending on discretionary that might be able to be redeployed to other areas of your agency, and then find some opportunity for hiring, maybe some profitability that gives you opportunity to acquire, or maybe invest in different things. But that is what happens when an agent looks at their P&L as a percentage of revenue and uses those benchmarks. These are common things that are the outcome of doing that exercise. I think every agency should have a budget. That way you can use the benchmarks as your guide, but you can also use your own goals as your guide. This is a free tool that you can build your own budget using our structure. Allows you to look at and update a 12-month budget and forecast with clear assumptions, manage your debt, integrate your tax strategy, all that good stuff. So anyway, that's something that's important for, I think, everyone to see. The last thing is, now that's just the agency as a whole, what those benchmarks should be, or what those KPIs should be. But what about by role? There's lots and lots of numbers when we're talking about a producer. And I think about the metrics that you have for producers. There's leading metrics and there's lagging indicators. So the leading will help you predict, is this producer going to be able to achieve the goals that we've set for them? And the lagging indicator is, it's already done. These are the numbers and we know whether or not we've hit the goal or not. So for instance, if you set a goal for a key producer to hit certain new business, and what the close ratio is between proposals, appointments, and calls, you can just monitor the number of calls and appointments and be able to predict whether or not we're going to hit those new business revenue goals. Same thing is, are they managing their number of center of influences? And you know how many leads we get from those centers of influence. We should be paying attention to, are we doing the calls with the centers of influence? Are we actually maintaining those relationships? Are we getting the leads in order to drive the funnel, in order to get the production? But paying attention to these number of calls, number of appointments, number of proposals will be a great way to intervene and make sure that if you have a problem, you get to it quickly and can rectify the problem before the end of the month or the end of the quarter, when we see that we're not having the success that we would like. So this is just an example of how you create a dashboard to show whether or not a producer is hitting those goals or not, and maybe even put it up for some friendly competition, how many calls they're doing, how many proposals were sent, how many meetings were sent, etc., could actually be a great way to create some excitement around that. We had one agent in Texas come and present to us about all their dashboards and how they do March Madness, and all the numbers are about the leading indicators, not the lagging indicators. And those that were doing the volume of work were actually were rewarded during that. Same thing on the CSR or the account manager side. So the number of opportunities for cross-sell, the average policy per customer, the number of monoline policies, are we able to reduce those? Number of referrals that they made to producers, the number of completed customer calls, even sometimes the duration of the call. And the other one was the number of Google reviews. So, if you're able to get NPS score, Google review, etc., those are all the result of being able to do all of these work. But again, I said when I started this, there are a ton of metrics that are in our industry. The question is, are you a sales-driven organization? Are you a service-driven organization? What are the metrics that make the most sense for you? But if you're going to create goals for your people, make sure that you have the metrics and it's measurable, and you have a blend of some leading indicators and some lagging indicators, because lagging, once it's done, it's done. There's really, other than you might be able to go post-mortem and figure out why are we off. But if you have some leading indicators, you will know in advance that you're either going to crush the goal or potentially fall short of the goal, and allows you to have a much better line of sight on your agency if you're able to do that. So other data and insights or metrics that we have, we definitely do a cost per customer. Some agents are even going down to the cost per transaction, what the revenue split is, the concentration by producer, concentration by niche, a carrier concentration. All these things can help determine whether or not we have a profitable line of business. If we have something that you want to double down into, something that you maybe don't want to market to, where your carriers are and where you have opportunity will determine some of that. I would just also caution you, don't be like this girl and try and consume all of the numbers all of the time. They become gobbledygook and really not important to you. So really focus on the things that make sense. So the top 5 mistakes, they are not, if you have KPIs that are not specific and measurable, and they are not something that you can actually quantify, then they're really not a metric at all. If you only select the metrics you can't influence, they're already done, that isn't going to give you action. Probably the most common one is we measure everything, or we measure what we've always measured and we're not really sure what we're going to do with it. That's just busy work. I had one agent that had a bonus structure for his producers that when he told it to me, it took him 30 minutes to explain it to me. And I said, how do you get to all those metrics to be able to implement that bonus structure? And how do your producers, do they take the time to calculate all of that in order to know how they're being, like, it was so labor intensive, and I'm not even sure he had clean metrics in order to do it. It made me wonder, why are you doing it? And it was great intentions, but those metrics are not easy to get to. You got to simplify and really figure some things out there. One of the biggest problems is trying to measure everything, and therefore none of it becomes important, or you have no team buy-in and they don't think the numbers are right, so therefore they discount what's happening, or you're inconsistent with those numbers, or they can't see how the numbers are tied to your priorities. If you've got metrics over here, but goals that have different structure, there's really no cohesion between the two. It really doesn't allow for your team to really understand how can they influence the performance of the agency, and how do I connect? How does my role connect with everything you're trying to do? And if you're not able to do that, it's really, again, a futile effort in trying to figure out what metrics to look at. So in my opinion, what gets measured gets managed. If you're able to focus in on the things that drive the performance of your agency, you're going to go really far. Less is more. I would think that, I'm happy to answer any questions, but I would also challenge you. What's one thing that you would take back from this, that you would change in your agency, or think differently about what KPIs you would use to support how you lead or how you create goals inside your own agency? We're getting ready to start planning for 2026. If you haven't already, maybe something from this gave you an idea of how you might set those goals differently in the coming year. I hope it has. And if you have any questions, I'm happy to hear what you have to say. Anybody? All right. Sounds like we don't have any questions, Carson.
Sorry, my camera's not working. Can you hear me at least?
I can hear you. Yes.
Okay, I don't know why it's not working. Anyways, well, thank you so much for everyone for coming. That was so fantastic, Carey. I love that little budget template that you provided. That is super cool. So I would definitely add that in to the follow-up email from today. So thank
Perfect.
you everyone for joining us. That was our final webinar in this series, but we hope to have Carey back soon for many more sessions like this. So you can check out Carey and Agency Focus. They're doing some really great work that we highly recommend. So if there's not any questions, I think that is all for today, and we'll see you all next time.
All
Thank
right.
you,
Take great
Carey.
care, Carson. Bye-bye.